It's 1:30 p.m. right here in Lagos, Nigeria. Coming up, International Monetary Fund warns if U.S. default could have very serious repercussions on the global economy. The Zimbabwean government lifts all restrictions on importation of basic commodities in an effort to stabilize the economy. Plus, rich Kenyans are set to get helicopter tax cuts in President Ruto's budget plan. Hello, welcome to the program. I'm Ladi Williams. Hope your afternoon is going great. But let's kick off with the markets now. Let's see what's happening on the African continent. Starting here in Nigeria, we see it's green, marginal green right now, marginally green right now on the NGX, 0.02%. That's the trend we see normally these days. Yesterday was down about 0.04% at this time, but now we're seeing positive right there. And the South Africa index closing up 1.56%. Big move there at intraday for the South Africa JSE index. Let's look at other parts we track there. We see in North Africa, the EGX30 did close yesterday 1.28% down. In Kenya, again, losing our 100 all-share index points level, down 2.16%. We'll check out what's going on in Kenya some other time. Now, let's take a look at what's happening right here on the NGX. Joining me now is Mr. Rotimi Fakaejo, equity trader on the NGX. Great to have you on the show. Can you hear me?
Good afternoon.
Good afternoon. Great to have you. So, last time I checked, the NGX was up about 0.02%. What are you seeing in the market right now, and who are the big drivers?
Well, the market is still very much up to that extent, and the major drivers right now are Access Corp, Ikeja Hotel, Transcorp, Adova, and Sovereign Insurance. And this is quite unusual at this time because Transcorp is back strongly in the green and is definitely giving the market a lot of momentum. Well, on the losers chart, we're having CI Leasing, FTN Cocoa, CWG, and Unilever. And the major drivers of volume today are Access Corp, IBN Holdings, and also Fidelity Bank. And I think the market is getting to another level that is very, very positive and encouraging, in the sense that in the last 1 week or thereabout, we have seen the daily average value traded being a minimum of about 4 billion naira. And I think that is quite good at this time because people believe that by this time the market will be in doldrum. But it's quite surprising that we are still moving on and very strongly. So I believe strongly that the fundamentals are still the major drivers of the market. Investors believe in this market, and should we have a very robust package plan coming from the new incoming government, then definitely the all-share index is going to hit the roof this year.
What are you expecting next week?
Well, I think next week, definitely, we've seen as at date, with the position of the market relative to last week, the market is still about 0.5% down comparatively. And I think this definitely there will be an improvement next week because we might not see that downward trend as we have seen. And we might see major movers of the market, the highly capped stocks, actually taking shape and changing the momentum in the market positively.
All right, fingers crossed for the close today on the NGX. Thank you so much, Mr. Rotimi Fakaejo, the stockbroker NGX. Thank you.
My pleasure.
All right, let's take a look at what's happening in the Middle East now. We see the Abu Dhabi index. It's negative sentiment in the UAE, 0.33% down as the Abu Dhabi index, and Dubai, that's also down 0.40%. Other markets we track, Saudi Arabia and Qatari index closing positive yesterday. Saudi Arabia index almost 1%, a big move to close yesterday. Let's take a look at what's happening with Europe now. We see German car maker Volkswagen is under new pressure from investors regarding its business in China. Investors shareholder meeting this week lamented the company's falling market share in China. Well, Stephen Beardsley joins me now. Great to have you, Stephen. So, how has Volkswagen responded to these concerns?
Well, Volkswagen has really two major issues in China when it comes to shareholder concerns. And the first is its place in the market, frankly, and that it's losing ground to Chinese competitors. Volkswagen seeing its market share fall to 16% last year from about 20%, according to analysts. Now, Volkswagen says that there is a positive outlook. However, it acknowledges it's had some difficulties. It says that the first 3 months, for example, of the year, it saw its sales rise by more than 40%. It points to its newest electric model, the ID.7, which is going to hit markets in September after debuting at the Shanghai Auto Show in April. And it also says that it's working much more diligently to answer some of the operating system problems it's had in the Chinese market. Software has been an issue that's really bedeviled Volkswagen over the past few years. And in particular with the Chinese market, there's been criticism that its software wasn't tailored to that specific market. Now, the other big criticism that Volkswagen is going to face in China is its production, especially from Western countries. They look at what's going on in the western region of Xinjiang. That is where Volkswagen has a production facility in the town of Urumqi, and it's also a region where the UN has documented many episodes of forced labor over the past years. Now, Volkswagen says it itself cannot document or cannot find evidence of any forced labor in its facility, but it also acknowledges that that facility is run by its Chinese partner, a company called SAIC, which would have to sign off on an independent audit of the building, of the facility, something that it has not done. So until there's more movement on that issue, we're probably going to see criticism continue to remain quite high, if not increase, in the months and years ahead.
All right, Stephen, but why has the company struggled so much in China?
Yeah, Volkswagen certainly has a long tradition in China. It's been one of the major car makers, one of the first major foreign car makers to really take the market seriously. What's caught it flat-footed is really the shift towards electric vehicles. The Beijing government really making the shift to electric a priority. And since this is the world's largest car market, it is a massive market for these companies, and they have to move fast if they're going to catch up. Volkswagen has had problems with that shift to electric in general. It's, of course, well known for its engineering, its design, when it came to internal combustion engine models. But with electric models, it's had a real particular issue with software, as I've already mentioned. That's been something where it's really fallen behind. Some of the modeling and production has also been criticized. And in the meantime, we're seeing more Chinese competitors come up and gain more attention. BYD is the market share leader when it comes to electric vehicles. That's a Chinese company with more than 40%, I believe. Tesla has 10%, for example, and that's up from previous years. So it is a very competitive market, and it's only growing more competitive, especially when you look at the fact that these Chinese car makers, at the end of the day, are ultimately going to be supported by the Chinese state.
All right, TGIF, Stephen, what can we expect from European markets today?
Yeah, what we're seeing today is that some of the worries that were pressing down on Wall Street are going to come over a little bit, it seems like, and that's because the Fed signaling that there could be more rate increases coming as inflation remains stubborn. Of course, the latest reading showing that it is continuing to fall, but not at the pace that many have hoped. And so with that in mind, there's another more likelihood, I should say, of further rate increases, and that tends to dampen the spirits on Wall Street and in other markets when they look at business profits. Otherwise, trading has been pretty flat when it comes to European markets, especially here in Germany, with the DAX starting out at just 0.5% up to begin trading, and it's not expected to go too crazy in one direction or the other.
All right, looking for all the markets perform next week. Thank you so much, Stephen Beardsley, right there in Berlin. Thank you. All right, let's take a look at what's happening in the U.S. now. We see U.S. stock futures were higher today as regional banks rebounded and traders tried to end a volatile week on a high note. Dow Jones Industrial Average futures rose 126 points. You see right there behind me, 0.37%. That's what's trading for the futures market. S&P 500, that's up 0.36%, while the tech-heavy NASDAQ 13,000 there, trading up 0.21%. Be looking to how this market's actually closed today. But still on the banking woes in the U.S., our correspondent, Mary Bird, spoke to Bart Ramurti, White House Deputy Director of National Economic Council, on what to expect in the banking industry going forward. Take a listen.
Thank you so much for joining us. We know it's a very busy time, and we know that Americans are wondering about their money, their finances. What does this mean for their financial stability? Can you tell us a little bit more about what Americans should be feeling at this time, how confident they should be in the banking system, and can we anticipate to have any other banking failures in the coming days and weeks ahead, and what the government is doing to try to avoid that?
Yeah, I think the main message for people out there is that they should feel confident that their money is going to be there if they need it, that the deposits that they put into the bank are going to be accessible to them immediately and in full. And I think that's in large part thanks to the actions that the administration took about a week ago at this point to stabilize the banking system, to do that without putting any taxpayer dollars at risk, while making sure that all of the management at the banks that got into trouble are being let go. And so there's some accountability there. But it was really important to us that we immediately stabilize the banking system and make sure that everyone had confidence that their money would be there if they needed it. And I think thanks to those actions today, we can now say everyone should have that confidence.
We know that U.S. Treasury Secretary Yellen today spoke, on Tuesday, spoke regarding kind of the stability, as you just mentioned, of the banking system. What are some of the policies that Biden's administration is hopeful will be put in place, and what is he asking Congress to do? As we know, the laws are a bit limited as it relates to being able to avoid these type of banking failures.
The actions we took about a week ago under the existing laws that Congress has passed helped stabilize the system, and I think right now our main priority is making sure that the system remains stable. Number two, the president has been clear that there has to be accountability for the executives that led the bank into this situation. And accountability for other executives out there, so that they know that if they create problems that could destabilize the banking system, that they would be held accountable for that. So he's already sent up a proposal to Congress last Friday of 3 specific measures to improve accountability, making sure that we can recover compensation from executives. For example, if they sell their shares in the bank right before the bank goes under. And to make sure that for particularly culpable executives that they are barred from working in the banking industry again, a big accountability measure. The third thing that the president laid out as a priority is making sure that we're not back in this position again. You know, the previous administration, there were a lot of deregulatory steps taken on exactly this category of banks. Banks that are not the top 10 biggest banks in the country, but are just that level below. That was a target for deregulation of the previous administration. And so a lot of the rules that they rolled back, you know, in our mind, we have to consider whether to put those back in place to make sure that we're keeping a really close eye on these types of banks going forward, and that we catch these kinds of problems before they spiral into the kind of economy-wide, banking system-wide problem that we were facing over the weekend about 10 days ago.
Yes, and we also know that even prior to these banking failures, the U.S. economy was in question by many Americans. We know that this has caused interest rates to increase at a rapid rate that we haven't seen in almost 30 to 40 years. What can we anticipate that Chairman Powell will do in the coming days as it relates to the interest rates in light of what we've seen with the banking failures over the last few days?
It's a good question, but our view here at the White House is that we are not going to either prejudge or comment on the Fed's interest rate decisions. You know, the Fed is an independent agency. The president feels really strongly about that. He doesn't think it's appropriate for the president to be out there saying that the Fed shouldn't raise interest rates or should raise interest rates. So we're not going to comment on that exact question. But what I think is important is that our economy, the underlying fundamentals of our economy, are still a lot better than when the president took office. You know, the unemployment rate is still close to a 50-year low. Wages have been rising consistently for the past several months. If you look at surveys, Americans say now is the best time to find a job in their living in their life in the job market. And so we think that there's a lot of good things happening in the economy. Of course, inflation continues to be an issue. It's something that's come down over the last several months, but we still have a ways to go. And we're focused on that, and as is the Fed.
That was our correspondent, Mary Baird, speaking with Bharat Ramarty there, a White House official on the banking industry in the U.S. But still ahead, we'll be gauging the South African economy as the South African rand hits a record low. More market turbulence. That's our next conversation. Do stay with us. Welcome back. Well, the South African rand hit an all-time low today, 4 pairing losses. Rand at one point sank as low as 19.51 to the dollar, down more than 1.6% on its previous close. Let's talk to Matt Kindiger now, practice leader, Sub-Saharan Africa, front of you. Great to have you.
Hi, can you hear me?
I can hear you now. Great to have you, Matt. So it's a new low for the rand. What's driving this?
Yeah, so the rand is really being driven by a number of factors. Unfortunately, the rand is being battered by both domestic factors and global factors. So there are obviously concerns around the global economy. The South African rand is a bit of a bellwether for what's happening globally. When emerging markets sneeze, the rand catches a cold and tends to exhibit quite significant volatility as a result. But really, the new record lows are fundamentally being driven by domestic factors, domestic political and economic factors. First and foremost, the increasingly clear evidence that South Africa's military and economic relationship with Russia is deepening, and this is causing investors to become quite anxious about future risk of sanctions, for example, on the country, but also associated weakening sentiment towards South Africa. So that's certainly one of the major drivers. The other is domestic power shortages. Load shedding, as it's known in South Africa, is getting a lot worse. We have seen extended periods of power shortages in the country, and this is really undermining the country's industrial base. So certainly prospects of much weaker economic growth are filtering through into investor anxieties and driving down the rand.
And talking about investor anxiety going forward, what's the outlook for the rand?
Yeah, so our view is, because of the reasons we just mentioned, we expect power shortages to get a bit worse over the next few months, especially into the winter in South Africa. Investors becoming increasingly concerned about South Africa's relationship with Russia. Our view is that the rand will end the year at further than 20 per dollar, so well beyond 20 per dollar, possibly 21, 22 per dollar, delivering an average of close to 19.5 or 20 per dollar. But we would say that there will be periods of significant volatility, so there will be obviously depreciation, but there will be periods of considerable appreciation as well over the short term, driven by the South African Reserve Bank's decision to raise interest rates. In our view, the SARB will raise interest rates to stabilize the value of the rand. But also, as the global economy picks up a bit towards the end of this year, we would expect investors to invest more in emerging market currencies, including South Africa. So although overall not a great picture for the rand, there will be some volatility going forwards.
With the war in Ukraine, there's definitely risk of secondary sanctions going forward. How likely is it that South Africa will face Western sanctions over its relationship with Russia?
So it's currently not our base case, although the risks of sanctions on South Africa are rising, in our view. So a few months ago, we would have said it's very unlikely unless there's evidence that South Africa is supplying lethal aid to Russia for its war in Ukraine. Unfortunately, over the last couple of days, the US has made some allegations that South Africa there is evidence of this taking place. If these allegations are confirmed, and if it becomes increasingly clear that South Africa has a very close military relationship with Russia, then unfortunately sanctions are likely. However, they would probably take one of two forms. First, we're more likely to see targeted sanctions on individuals, say, for example, in government or the armed forces. These would not be broad, sweeping trade or economic sanctions. But nonetheless, this would have a very negative effect on sentiment, even if it doesn't affect trade to and from the US and South Africa, for example. So certainly increasing chance of sanctions, but unlikely to see very sweeping trade and economic sanctions, at least for the short term.
I guess we're going to blame that on being in the same block, talking about BRICS. Well, how will all of this, affect South Africa's economic growth outlook for this year?
Yeah, so a few things. So certainly the weakening rand will have a negative effect on growth in South Africa, firstly because the South African Reserve Bank will be forced to raise interest rates to stabilize the rand. This will increase the cost of borrowing in the country and reduce credit growth, which is not great considering how large and sophisticated the country's financial services industry is. But there are also impacts on inflation. A weaker rand will drive up imported prices of products. This will drive up domestic consumer price index. but also the concerns around the country's trading relationship with Russia, military relationship with Russia, will have a very negative effect on sentiment. And if we do see even targeted political sanctions on individuals in South Africa, we will see quite considerable divestment from the country, in our view. Additionally, it's always worth remembering that power shortages in South Africa are getting really quite bad. We do expect this to be the major driver of the country's stagnation this year. We're forecasting economic growth of 0.6% this year, but there is an increasing chance of a recession, mainly because of the power shortages in the country. So more or less, the country should expect stagnation this year and into 2024.
All right, guys, we'll keep tracking that economy. Thank you so much, Matt Kindiger, practice leader, Sub-Saharan Africa Front Review. Thank you.
Thanks for your time today.
All right, still in Southern Africa now, we see the Zimbabwean government has lifted all restrictions on importation of basic commodities in an effort to stabilize the economy and tackle resurgent price madness. Move comes as the government granted 100% retention of domestic foreign currency earnings. Recent price increases linked to wild parallel market rates have led to the erosion of people's incomes and constraining aggregate demand for goods and services. The Treasury will adopt all external loans to the government and continuously review domestic interest rates to promote wider local dollar usage and savings by key economic players. And the IMF has issued a warning of severe consequences if the United States defaults on its debt ahead of the approaching deadline for the country to raise or suspend its borrowing limit. The IMF Communications Director, Julie Kozak, stated that a U.S. debt default would have very serious repercussions, not only for the U.S., but also for the global economy. Take a listen.
Come together, reach consensus to urgently resolve the matter. And of course, the reason that we're calling for this is because we are concerned about the severe repercussions for both the U.S. economy, but also the global economy. The situation in the U.S., of course, is marked by some uncertainty. At the same time, we have seen resilience in the labor market in the U.S. And in some of the underlying economic figures. So on the U.S., I think the bottom line is right now, our April WEO forecast remains relevant. We see that the impact could be 0.2% of global GDP, or the cost of fragmentation could be 0.2% of global GDP. But if we move into the realm of more extensive or runaway fragmentation, the cost could be as high as 7% of global GDP. And if we add technological decoupling, the cost could rise to 12% of GDP for some countries. So we are encouraging countries, when they look to strengthen their supply chain, to do this on the basis of economic logic, as our managing director has said, and to limit these costs very much to the lower end of that bound to ensure that the global economy remains strong and robust.
And to East Africa now, President William Ruto's administration in Kenya has proposed to eliminate 3 taxes on aircrafts and parts, including the 16% value-added tax, 3.5% import declaration fee, and the 2% railway development levy to benefit wealthy Kenyans, politicians who import helicopters and planes, especially those weighing less than 2,000 kilograms. The move is expected to boost the aviation industry, but may not sit well with middle-class workers who will face higher fuel and salary taxes to fund the government's ambitious pension. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye for now.